Better late than ever. We're starting the live stream right now. I almost said it's Friday. Tomorrow is Good Friday, so the market's closed. I will be here. I don't expect to do a live stream tomorrow, but I'm getting it in now. So we're getting a little bit of a late start today, but it's just one of those weeks. It's been very busy. It's the end of tax season. Uh, Lots of clients getting in there last minute Roth IRA and IRA contributions. For those of you who are rushing in your SEP contributions for last year, you still have time to get those in. Those aren't due until September. And just a quick fun fact for those of you who don't know, when you open up a Roth IRA and fund it for your child, either a Roth IRA or a traditional IRA, that money doesn't count as an asset for FAFSA purposes, for financial aid. So it's a good way to help your child save money and get the money, uh, and it's a good way to help your child save and invest and hide the money from the FAFSA application. It's still the child's money. You're still doing everything legally, and now your child has money for the long term. If a kid is 16, 17, 18 years old, whatever, they have to have earned income. And what I mean by that is for a child to make a contribution to a retirement account. Okay, what I mean by that, for a child to make a contribution to a retirement account, it has to be earned income. That does not mean mowing neighbors' lawns, which is great and all that. I totally respect, and a lemonade stand and whatever. But if the child earned cash that was not part of W-2 wages or 1099, that something where they had to pay taxes on it, they don't get to open up an IRA. The IRA has to be the contribution has to be has to be based on earned income. So if a child made $3,000, the child could invest $3,000 or contribute $3,000 into an IRA, Roth or traditional. If the child made $1,500 last summer, for example, then the max contribution for that child is $1,500. If they made $10,000 in a year, well, the max contribution for anybody is $6,000. Okay, $7,000 if you're 50 plus, but we're talking about kids here. Anyway, I have a high schooler who is going to make a Roth IRA contribution, and that money will be in his name. The good thing is it will not count toward FAFSA if that's what it comes down to, but that's what you could do, and that's what you could decide. So we all want to try to get as much aid and whatnot as we can for college. If you can get it, why not? If you can't get it because you don't qualify, it's not the worst problem to have. That's a first world problem, as we like to call it, right? So that's how it all works. Anyway, we're going to talk about a couple of things. The stock market is like just so desperate to pick a direction. It has picked a direction. It's picked a down direction. It's another down week. And, we're midway through April. So if we don't have a nice size recovery, we're going to have another down month, and people are going to really start to see their accounts go down. And I'm not talking just about people who invested in meme stocks or who are overloaded in technology and semiconductors. It's going to be everybody, even you know, uh, someone who thinks they're being conservative by investing in index funds. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index, like an index fund. Okay. Uh, but for people who have a diversified asset allocation model, and I certainly condone that. I have clients in asset allocation models. Okay, and they're made up of passive index funds, but those are coming down now too. It's not just people who got caught up in meme stocks or pandemic stocks, but the major averages have been holding up pretty good. The major averages are still not down a ton from their highs, by the way. It's not like we're in a brutal bear market, but I'm going by the major averages. So not everybody's feeling the pressure. If you're invested in, like, the DoorDashes, the Zoom stocks you talk about all the time, you are feeling the pressure. You are getting your accounts are just getting smoked. But people who are, the large cap investors in S&P 500 type large cap investment products, they've been holding up, but now they're starting to see their accounts go down too. And when you have good news from companies or what seems to be like good news, and the stocks like Goldman Sachs that came out with pretty good news, and they still manage to go down, that tells you it's a bear market, because in a bull market, all the news is interpreted as good. A company missed earnings, but they had good revenues. Company missed revenues, but they had good earnings, and the stocks go up. And now it's the opposite. If they miss either on earnings or revenues, it doesn't matter. The stock goes down as opposed to going up in a bull market, and that's where we are. And this is why I've been saying to people, you really have to be prepared to see your portfolio go down. You're going to be investing now, knowing that your portfolio is going down. And I've been saying this for the last couple of weeks. You've got to accept that. I'm an investor also, and my portfolio is going to go down just like yours. That's not what's important. I mean, I hope you. Let me run the banner over here while I got you. I have to run the intro in a second as well. Okay, but I want you to understand something. As a financial advisor, and hopefully you are working with a financial advisor who you have a good relationship with, it's not my job to only keep you invested during bull markets and get all your money out of the market in bear markets, or to keep you invested in economic expansions. But if we go into a recession, I'm supposed to know exactly when they start and always get you out ahead of that and get you in ahead of the next stock, in the next economic recovery. That's really not what I'm here for. I know we enjoy talking about the economy and the stock market, but I have a couple of jobs, but my jobs don't include having a crystal ball. And I think sometimes people expect a financial advisor to do that. I'm on different forums and Facebook pages about retirement, saving for retirement. And, I see people talking about financial advisors like they have this expectation that, their advisor is supposed to tell them to get out of the market at the right time. That's not what we're here to do. Now, if you're a financial advisor and you're watching this, you are welcome to disagree with me. My job is to keep you sticking to your plan, to keep you invested in the market through thick and thin, because ultimately, long term, we expect it to go much higher. And you bouncing in and out, waiting for it to go up and trying to time it. Some of you can do it, but most of you won't be able to do it on a consistent basis. So even if you do it once or twice, or you could do it 10 times in a row, time the market perfectly. It only takes one time to give back all of the gains from the 10 times you did it perfectly. So the job is to help you, to help protect you against yourself, to help protect you from yourself. I keep you invested. I help you understand the lay of the land so that you feel more confident hanging on to your portfolio and your financial plan in spite of what's happening externally. Because what happens in the stock market is external. You can't control that. That's why I say the way I know I'm doing well for myself and my clients in the market is if I'm investing consistently, reinvesting dividends, taking advantage as much as I can of Roth IRAs and IRAs and FSAs, HSAs. Okay. These are the things that are really important. These are the things you can control. And these are the things that tell you if you're doing well with your portfolio, not because we're in a bear market or in a bull market at any given time, but if you do the things that I'm telling you to do, mostly sticking to the basics, almost entirely sticking to the basics, you'll look back and you'll judge your account that you did well. You just have to wait. I don't know. I hope this makes sense. I'm not here to tell you when a bull or bear market or a recession starts. I'm here to prevent you. I'm here to prevent you from acting on good news and bad news. I'm here to prevent you from getting carried away, like in a meme stock or something, or getting too heavy into just technology or too heavy into just semiconductors. I'll give you an example. Look at Nvidia, like arguably just one of the greatest semiconductor companies of our time. Lots of soothsayers on TV have been saying great things about Nvidia. One of them said this company is going to be so powerful. This is just a coiled spring. It's going to go up, up, and up and up. Stock is actually below the midpoint now between its year high and year low. it's in the low 200s. I think it could go into the hundreds, maybe. Look, there's no guarantee, but the way it's trading, it's an awful looking chart. So it doesn't matter how great you think a company is. Stocks are going to do what they're going to do, and you have to either be willing to hold on to it or don't get involved in individual stocks. The other thing I want to say is this about diversification. Now, I have to just say, boilerplate diversification, it's a strategy that we use to mitigate risk, but it won't protect your portfolio from going down in a generally down market. I think that makes sense. You could be diversified up the wazoo, but if the investments, if the overall markets are going down that you're invested in, your investments are going to go down too. People talk about the S&P 500 as this diversified index. It's not as diversified as you think. It's a very heavy bent into technology, very heavy bent into that. But it is a diversified portfolio in spite of how much it has, in spite of how much exposure it has to technology. So does that mean it can't go down? Well, it's going down. And this is why I started the show by saying people who are investing in a portfolio of passive index funds, your large cap, your small cap, your mid cap, your international, your bonds, they're all getting smoked right now. So diversification doesn't prevent your portfolio from going down. It does prevent your portfolio from getting wiped out by one investment, and it could help your portfolio recover faster, but it could also prevent your portfolio from maximizing gains as well, because you're not going to be 100% in the best performing investments at any given time. But I want to say this about diversification, because sometimes I feel like people think diversification is a cop out. Like, oh, what are you afraid of risk? You can't get into risk. You're too worried about investing. Diversification is not about fear. I want to get this across, because a lot of people think there's like some badge of honor by not diversifying, and that's in my opinion furthest thing from the truth. So here's two things that I want to teach to all new investors and reinforce to all you experienced investors. Okay, two things. The first one is this. Okay, investing is a sign of optimism, that you are still optimistic about the future in spite of not knowing what the future holds. Because if you were really pessimistic about the future, you wouldn't invest. If you were really like just horrendously pessimistic, you would just spend all your money now because there won't be a future, right? Now, what I'm saying is we know there's ups and downs in the future. We know there are times of plenty and times of pain. But you're still optimistic about the future, which is why you're investing. Investing is a statement that you are optimistic about the future. Diversification is a statement that you are open-minded, that you are open-minded to other opinions, to other outcomes, to other possibilities, to whatever the potential outcomes or possibilities are, and you don't know them in advance. We could all get on the hoot and holler and the squawk box and whatever and say, I think you should buy bank stocks, or I think you should sell bank stocks. I think you should scale back on stocks. I think you should just remain bullish because we're going up and up and up. I think you should own this, own that. All the opinions that you hear everywhere, they could all be wrong. And the market could still go up a lot because it could go up for other reasons that we haven't even thought of yet. That's why we diversify. We are open-minded to other people's opinions, to other possibilities that we haven't even imagined yet. Market goes down for things that we haven't even imagined yet, like a pandemic. Okay, so let's keep that straight. I'm going to roll the intro now before we forget. But I want you to stick with me. We've got a couple more things to talk about. I hope you're enjoying the show. And while you're watching, if you wouldn't mind, give it a heart, a thumbs up, a clap, applause, whatever reaction you have available to you, depending on what platform you're watching this. I see Liz is out there, and I got a heart from Liz. Thank you very much. And thank you so much for sending those beautiful pictures of my wife to me from Brandon's bar mitzvah. Those just, I really appreciate it. Those moments. I'm still in a state of shock, which is probably how I'm able to function a lot of the day. defense mechanisms are a very powerful thing. All right, so here is the intro. Got a couple things to talk about, and then we're just going to talk about what's going on right now in the market and why you may need to stay put or run out of the market. But at least you'll be making an informed decision, and it'll probably be something in between. Here we go. All right. Thanks so much for watching us. If you're late to the show today, that's okay. We're just talking about right now. We're going to get into how markets did. So let's take it to the tape. Put myself in here in the corner. So very slow day today. Big day for earnings, but not. I mean, the biggest fireworks today came from Twitter, Elon Musk. But we'll take a look at that in a moment. Stock didn't do anything after he announced that he wants to take over the company. The company's going to fight it, and it could be drawn out, and who knows what Elon's plans are, how much more money he wants to spend on it, and whatnot. But it's. I'm telling you something. It's a sideshow. It's a distraction. It's all it is. Okay. Dow Jones Industrial Average down 113 points. Not a big deal, but it does add to a short week, because today's Thursday, tomorrow's Friday. The market's closed tomorrow for Good Friday. So Dow off about 75, about 0.75%. NASDAQ get crushed again today, down almost 300. That puts it down almost 3% on the week. I mean, I don't know how many more down 3% weeks we're going to have in the NASDAQ, but if you get enough of them, NASDAQ could go to zero. And before somebody says, Mitch Goldberg says NASDAQ's going to zero, I'm just going by the math. If it goes down 3% every day, okay? 30 days in a row. I don't think we get that. S&P 500 down a little, down 54 points, but another 1% plus day. 1% plus moves in the major averages does get my attention, but it's down about 2.5, 2.3 or so down for the week. So the reason the NASDAQ and the S&P are doing so much worse than the Dow is because the S&P and the NASDAQ are tilted much more into technology, semiconductors, and then like consumer tech related stocks. So that's what's just getting hit. That's what investors are selling off, either to raise cash, to protect their portfolios, to protect gains that they've made already, and to maybe reinvest that money into the stocks that are going up, like drugs, consumer staples, a handful of reopening stocks like travel and leisure, and some industrials. Okay, oil, another up day. So we saw oil come all the way down to the mid 90s. Now it's starting to rally up again. Will it hit 130 again? It's high of the cycle so far. Tough to say. The 10-year treasury, that hit 2.8, 2.81 earlier in the week, late last week. I think earlier in this week. And then it came down, and people said, oh, that's it. Yeah, the 10-year yield, it's starting to go back down again. That's the peak. And I think inflation may be topping out. No. I didn't buy. I didn't think it would be a good idea to buy certain interest rate products. I'm just saying, I've got to be careful with what I say. If I say a specific thing, I don't want to, say like, oh, recommending or not recommending something here. But I'm just saying that I didn't think interest rates were done going up. They're 2.827. It's the new peak of the cycle. Your popular bond funds and bond exchange traded funds are getting clobbered. It calls into question the benefits of diversifying between stocks and bonds. And cash, which was trash for so long, is now looking like the absolute best asset class that there is, which is why I always say cash is part of the portfolio. Okay. The VIX, let's look at the VIX, up a little bit, up to 22.7. It's starting to get closer to 25, and that starts to show that people are really getting spooked. Okay. So that's that. Let's take a look at the bond market. The bond market. Yields across the board were higher. Let's look at the 2 year, 2.45%. By the way, the 1 month is finally above 0.25%. Now it's 0.261%. So people are getting ready in about 2.5, 3 weeks. The Fed's going to meet again, and they're expected to raise short-term rates up 0.5%. Last meeting earlier this month, they did up 25 basis points. Now they're going to go. Was it March? Yeah, it was in last month, 0.25 basis points. Now they're going to go 0.5 basis points. So we'll have 0.75% of rate increases. That's it's getting to be a little substantial, and they're expected to do another 50 basis points. The Fed meeting after that. Anyway, the 2 year at 2.45, the 10 year 2.82. And if you notice the difference between the 2.45 and the 2.84, so it's almost 40 basis points. It's really widened that spread. So the yield curve is steepening. We have this inverted yield curve, which everybody says portends a recession, but we were in it only for a matter of days. A lot of people are not trusting the yield curve because, the Federal Reserve has bought $9 trillion worth of treasuries. Now they want to start selling off the treasuries as early as the next couple of weeks, about $95 billion a month. The funny thing is, if the Fed reduces the balance sheet, let's say by 1.2 a trillion in a year, it's still, going from a $9 trillion balance sheet on the Federal Reserve to $8 trillion. It's still massive. What do they have to get it down to? I don't know. It's going to take years if they can even ever get out of this massive holding that they have. In any event, yield curve steepened. This should be great for banks. Like bank stocks, which have been either up and drop today or down or flat out down, like Wells Fargo took a big hit, which has been a leader for such a, for like the last year. And JP Morgan is just looking awful the way that stock is trading. They should be moving with the way these the yield spread between the difference between the 2 year yield and the 10 year yield as they get wider. Those bank stocks should be flying, but they're not. So it could be that bank stocks are like a coiled spring, right? Ready to take your deposit and run. That was pathetic. Okay, so let's take a look at cryptos. Cryptos down across the board. Bitcoin's back under 40,000. Nothing great here. Just, the NASDAQ had a tough day. So crypto had a tough day. NASDAQ and crypto are considered the more speculative parts of the market. I was looking at Microsoft, just to give you an example of like one of the best stocks that you could have. If you take a look at the range, 350 down to 279. All right. It's basically the middle of its range. I don't know if people realize how much Microsoft has gone down from its high. And take a look at Apple. The one that never goes down, right? It does. Not too bad, but 182 to 165. Still, it's down a good amount. And this is what I mean. People are starting to see their index funds like the S&P 500 go down because these big names that were holding it up while everything underneath them was, were a lot of stocks underneath them were crumbling. Now these are finally starting to take a big hit. Okay. Big news of the day. Amazon CEO Andy Jassy. Yes, you are correct. If you notice, it's not Jeff Bezos. He gave up the reins. Andy Jassy is now the head of Amazon. Not the big owner like Bezos, just he's the CEO. He's an executive, administrative. Okay. He says costs from the pandemic, inflation, and the war are too high for the company to absorb. That's pretty big news. Let's get a quote for Amazon. Let's see if I can just click it over here. Amazon is just getting smacked. It was down 76. So down from 3,700 to 3,000, not far from its 52-week low. Do you see how Amazon is literally below the mid-range of its 52-week low and high? That's pretty significant because Amazon has always been known to absorb costs, never hurt the customer. Look, I don't think passing on costs to the customer is hurting the customer. They're getting hurt too, and that's what you do. If things cost more, we pay more. But Amazon is just like not even us as the greatest deflationary force company ever. Like we can't even absorb what's happening with inflation today. We have to pass it on to our sellers and in turn to our customers. That's what's happening with Amazon, and the street is reacting pretty negatively. The stock is down 2.5% today. I would say that's like that, and how badly semiconductor stocks are doing are the big stories of the day. That's where we talked about Nvidia at the top of the show, and we spoke about semiconductor stocks in general, like Marvell, which is this incredible 5G technology company because everything's going 5G, and that stock has gone from the 90s to like 60. So it's lost over a third of its value. That's what a bear market does. It just takes good companies, it doesn't matter, it just crushes them. And they could go a lot lower. Yeah, people think, oh, that's it. It can't go any lower than this. I think a lot of people who are down in a stock, they make predictions not on where a stock could or should go. They do it based on their emotions, on where they want a stock to go. There's no emotions here. Stocks could go a lot lower after they've gone a lot lower, and stocks could go higher after they've gone a lot higher. No emotion, just the way it works. But in a bear market, the news that was perceived as good, you take and it's bullish. In a bear market, you could take the same exact news and it's perceived as bearish. That's the difference between a bull and a bear market. It's like a psychological, deeply ingrained thing. And the market, I expect, will remain a bear until people who think the market's going to turn around right now and go right back up to its all-time highs, those people have to finally be squashed and taken out. um, I'm talking psychologically, mentally wise. Okay, before the market finally stops going down. There's still too many bulls. That's what I think. And with the 10-year yield at its high of the cycle, after people thought a few days ago that was what we saw the high, doesn't look like we saw the high. I would love to just jump into some bond ETFs and get some good yield and add that to the client's accounts and just have something in the portfolios that is steady and paying a good yield. But we're not there yet. We're just not there. I don't, in my opinion. I mean, we could be, and I could be wrong, but I'm going by my experience and I'm going by the risk tolerance of clients. All right. That's my story. I'm sticking to it. This is the last show of the week on a Thursday anyway, even though the markets go tomorrow. But I'll be in tomorrow morning. Just I got to take some, I've just got like a pile of stuff that I have to get through and just work through and get off my desk already. It's driving me crazy. And I hope you guys have a very happy Easter, happy Passover, whatever you celebrate. And for those of you who celebrate neither one, I just hope you have a great 3-day weekend. Okay. Have a great weekend and see you guys Monday. All right. Ciao.